Okay, Fernando asked a question related to the married put questions, married put strategy, I should say, buying a stock and buying a new position. And so standard married put that I looked at, buying a stock and buying a put option, expectation is that stock will move up in price, but we're going to go ahead here. The blueprint talks about the 12 different ways that we can manage the position, apply income methods to lower the initial cost basis, generate income, and potentially bulletproof the trade. And that means when we have no risk left on the position after taking care, paying off some of the initial at risk, maybe still having 3, 4, 5 months of trading time with a no-risk position because we took care of that initial 4, 5, or 6% risk with the income methods. But Fernando says, is there a way with the tools on PowerOptions to calculate the probability of success POP with the married put structure? Not directly. You know, you've heard me talk before, Fernando, about what I use to look for and the type of chart I tend to read to find positions I feel would move up 3 to 6% in the first 20 to 30 days. So let's say that one of those I decided, don't see any of the ones I was hoping to get into recently here again. They might have dropped. Oh, no, D.R. Horton is there, DHI is there, eBay is there, and CDW Corp is there as well. Let's just take eBay, for example. And we'll just go to the profit and loss chart. So the thing is here is with the married put position. The one advantage you have with the married put is that even if you're wrong, even if something fell, like some of the stocks we saw in those pods today that showed a 15, 16% decline, 20% decline, the top 3 stock losers, and we also looked at the top 3 stock gainers. But even in the case of a 15, 20% unexpected move in the stock related to earnings or any other event, you know that you're controlled better than a stop order. If the stock fell 23% and you had a 5% stop order, you get filled and you get the 22, 23% loss. You can't get the market price for the stop order. The put guarantees that even if the stock fell 20%, $8 down to $32 per share, I'm still only going to be losing 6.5% on those positions in the worst case scenario. That's good because you know it's controlled. It's not hoping that your stop order will control your losses to 5 or 6%. It's guaranteed that you're not going to lose 5 or 6% on any position. Okay, now, the probability of success does depend on the stock moving up, but you can't factor in the fact of, well, if it does move up or even if it stagnates, I'm going to do something. I'm going to apply those income methods to get out of the position, to help me lower the risk on the position, to generate income and lower the cost basis on the position potentially. So it can't factor that in. This tool will show you what your expectations are if the stock does move, let's say that 5% I was expecting, let's say it goes up $42.50, goes up to $42.50 in the next 10 days or so, so somewhere out in September 17th, well, not even that far out really, it'd be right around September 10th, okay? So now this isn't probability that you're asking for, Fernando, but it does show me that if I make my 5%, I'm going to have a reasonable return on this position in the first 10 days, okay? 2 or 3% with just the growth and the controlled loss. At that point, I might look to do an income method or an adjustment. But what you'd have to ask yourself is that although we don't have a tool on married put that shows this probability, we show you the probability the stock would be above the put strike price. But that's not relevant really because we're all the way out to April with this particular structure. Okay, my plan is not to look for the stock to be trading above $41 by April. I want it to be trading above the put strike price within the next 20 to 40 days, if possible. That's what I'm looking for. And I can see here what would my success rate be or what would my profit be, not even taking into account the income methods I could do if the stock did match my targets. What you may have at your broker, Fernando, or what you may have on other services is looking up the POP, as you call it, or the probability of success on a long stock position. If you have a tool that you use or your broker has a tool that you use that tries to use, I don't do this personally, I don't put much stock in it, but if it tries to use, implied volatility numbers or things like that to project, there's a 28% chance the stock will be up 8% in the next 20 days. There's a 15% or chance it'll be up 22%. There's a 30% or 35% chance it'll be up 6% in the next 10 to 20 days, something along those lines. Well, then you can take the one you feel is most likely in the percentage gain, plug it in here, and see what your expected profit would be based on the Black-Scholes pricing models. But long term, the probability of success, as you've seen me show, using either the trade simulator tool or the simulated calculation tool on radioactive trading, where you can put in what is your expectation for gain, your projected loss on each trade, and your win ratio, and based on your investment, what would your potential profits be? Okay, and in this case, using the POP, the probability of success long term, that any loss you take is going to be controlled to the single-digit percents, which means any normal gain or outsized gain you experience in this direction is easily going to counter those. Again, this is one of the only strategies I've seen where simulations over time is that with the proper structure, you could be wrong more often right and still make money. Now, I'm not saying you're going to have a 75% success rate with this strategy. It's 75% of the time you're going to have winners. I'm at about 60, 58 to 60% of the time I'm winning, but I'm making 7% when I'm right with this 40 or 50% of my portfolio, and I'm only losing about 4% when I'm wrong. I could only be making 6% and losing 5.5% and still be doing very well. I could probably be making 5% and be losing 5% guaranteed because of the put option as an average, and be right only 50% of the time and still be making money. I can't do that with necessarily long calls. I can't do that with covered calls. You usually need to have a win ratio on covered calls of about 65 to 70%. My target for bull puts is 82 to 83% success rate minimum. I'm looking for 85, 87% in that case. So the answer is no, but you have tools here that can help you evaluate it. And if you're using other tools that are giving you an idea of what is the projected move on the stock based on implied volatility or applied volatility near term versus far term skew, or you see some of those parabola charts. I'm sorry, the parabola charts that say there's a 10% chance here. There's a 5% chance that the stock would move in this parabola, and there's a 7% chance here, 10% it'll be here, 25% it'll be here, and things of that nature. Well, if you use that as part of your analysis, put the expected price in here, and that would kind of give you a gauge of what profit you'd expect. Now, probability of success over time, okay? All right, so that's the best way I can answer your question, Fernando, regarding the probability of success on a married put. But I do know that instead of worrying about the probability of success on this structure, as I have to worry about with a bull put credit spread, because I need to be right 83, 84% of the time to profit long term, to hit the goals I want and to profit long term, I'm really focused on the probability of the trades. With this one, I'm not. Yes, I want to be successful. Yes, I want to have a better than 50-50 win ratio over time on the positions as I manage them and do income methods. But at the same time, I do know that this proper structure alleviates my concerns for probability. Now, Fernando, I'll be honest with you. If I had been trading, when I first started trading this technique in 2008 or 2007, and I only ended up in the first year with a 30% win ratio, and I was making 7% when I was right and only losing 4% when I was wrong, I still would have been behind the 8 ball and realized I'm going to have to restructure my stock selection and or restructure the trade so that I can get a better win ratio, because I wouldn't be making money. But I've been able to hold this 60-65% win ratio with making, on average, of the trades that I make during the year, 3 to 4% higher than what I'm averaging on my losers, and that pays out extensively over time. Okay, better than most other strategies. All right, here we go. So Sam comments, it's not related to this. We'll get off the married puts now. If anyone has any other comments on that, or if maybe we'll run a scenario on the trade simulator tool I mentioned if you'd like. Sam says he tried to buy a put in Alta but did not get a fill. Okay, I don't know if you were trying to buy a put in Alta today. Today was kind of tricky, wasn't it? There was a lot of movement. I saw, even though the movement was up, we saw the Dow go up 150, 110 at the open, only went up about 40, but still a decent gain. These days always make me nervous, going into a 3-day weekend, when you see most of the markets, broad market indicators are up. The VIX had pulled back significantly this morning, but then came back up. That's kind of interesting, isn't it? I always get a little nervous heading to a weekend when I see the broad-based markets are up, which implies that fear is sort of subsiding a little bit. Could be driven by some of the strong earnings today. But at the same time, the VIX is up about 6% on a day when the indexes were up. Always a little bit nervous for me going into an extended weekend to see what that means and what's going to happen. Yes, I'm still in VIX calls right now. Only a few of them that I bought when the VIX was around 15. Sold half of them, I think, when it jumped up to 21.50, I think, recently. Sold another half when it was around 20 a couple days ago. But I'm still holding about 4 or 5 that are profitable. I'm just using that to hedge some of the other positions in my portfolio if they start to take a loss. But sorry, it looks like those bull puts are going to be okay. Okay, another way to hedge, Sam says, if you don't want to necessarily buy a put option, we were talking about, remember, Roku, and I said you could buy back the cost of the call. That would still keep your total cost basis in the stock 4 or 5 points below where it's trading right now. So you've got some locked-in gain where you might be able to buy a put option far out in time for the married put trade, essentially, if you're expecting to trade it multiple months and want it to have control better than a stop order. But yes, we had to pay a premium for it, but it's now guaranteed in case there's another drop. Sam just commented and he had a similar position where he has a lowered stock price and it's currently trading at, he bought the stock around 130, it's trading at 171, and right now he's got an October 200 call. So rather than buy the put, he's setting a mental stop or a trigger stop at 5 or 6% in that case, but he's selling the call to generate premium. And that's a positive way with such a large gain. Right? He's already got a 40-point unrealized gain in stock, so setting a 5% stop loss, even if it does drop suddenly 20%, he's still going to be at a profit if he gets filled at the 20% from where the stock is now, right? It'd be $34 down. Yeah, you'd still be roughly at a profit on that position, so that's okay. Okay.